Dead stock is a term that might sound a bit intimidating, but it's something that every business owner should understand if they want to keep their operations running smoothly. So, what exactly is dead stock? In simple terms, it refers to inventory that hasn't sold and is no longer in demand. You know those items sitting in the back of your store, gathering dust? That's dead stock. It takes up valuable space and ties up financial resources that could be better utilized elsewhere. If not managed properly, dead stock can lead to significant financial losses and negatively impact a company's bottom line. Now, why should we care about dead stock? For one, it can be particularly problematic for small businesses. Unlike larger companies, small businesses often don't have the same resources to absorb the costs associated with holding onto unsold inventory. Every dollar tied up in dead stock is a dollar that could be invested back into the business. Additionally, a large amount of dead stock can signal to customers that a business isn't in tune with market trends or lacks effective inventory management practices. This can decrease customer trust and loyalty, ultimately affecting sales. Let's talk about some examples of dead stock. Picture a clothing store that stocked up on winter jackets in preparation for the season. They anticipated a high demand, but when the season ended, they still had a pile of unsold jackets. Those jackets are now dead stock. Not only are they taking up valuable shelf space, but the store also incurs storage costs, and the jackets will soon be considered outdated. Customers may walk in and see last season's styles, which could lead them to believe the store isn't keeping up with current trends. So, how does dead stock relate to accounting? Well, let's dive into that. Dead stock can impact a company's balance sheet, income statement, and cash flow statement. On the balance sheet, dead stock is considered an asset, but it can quickly become a liability if it remains unsold for too long. This ties up financial resources that could be used for more productive purposes. On the income statement, dead stock can lead to lower revenue because it represents unsold inventory that hasn't generated any income. Additionally, the costs associated with dead stock, like storage fees, can increase expenses, further hurting profits. Now, let's discuss how to prevent dead stock from occurring in the first place. The first step is to forecast demand accurately. By analyzing sales data from previous seasons, businesses can get a clearer picture of what items are likely to sell and adjust their orders accordingly. Monitoring sales data in real time is also crucial. If a product isn't moving, it's essential to take corrective action before it becomes dead stock. Another effective strategy is implementing a just-in-time inventory management system. This means ordering inventory just in time to meet customer demand, reducing the risk of overstocking. Product bundling can also help move slow-moving inventory by grouping related items together and offering them as a package deal. Promotions and clearance sales are great tools for incentivizing customers to purchase items that may not be flying off the shelves. Now, when should a business consider implementing dead stock management strategies? If you find yourself with excessive inventory that isn't moving, or if you have outdated products taking up space, it's time to take action. Seasonal products that aren't selling or slow-moving items can also be indicators that dead stock management strategies need to be put in place. Dead stock can occur in various industries, but some are more susceptible than others. Retail is a prime example, especially with seasonal items that can quickly become outdated. The manufacturing industry also faces challenges with dead stock due to long lead times and the need for accurate forecasting. The food and beverage industry is particularly vulnerable due to the perishable nature of its products. Technology companies also struggle with dead stock as products can become obsolete almost overnight with the rapid pace of innovation. Who is responsible for managing dead stock within a company? It's a team effort. The purchasing department needs to evaluate customer demand and order inventory accordingly. The sales department must monitor customer preferences and provide feedback to ensure inventory levels align with demand. The marketing department plays a crucial role in promoting products and identifying trends, while the operations department manages inventory and ensures products are available to customers. Lastly, the finance department must keep a close eye on the financial impact of dead stock and work with other departments to minimize risks. When it comes to disposing of dead stock, there are several methods businesses can consider. Liquidation involves selling dead stock to a third party at a steep discount, allowing them to recoup some of the initial investment. Donation can be a great option as well, providing tax benefits and supporting charitable causes. Recycling, repurposing, or even destruction are other methods that can be employed depending on the situation. The key is to have a plan in place for disposing of dead stock to minimize its financial impact. Forecasting demand is essential for avoiding dead stock in the future. By analyzing historical data, conducting market research, and collaborating across departments, businesses can develop more accurate forecasts. Predictive analytics and machine learning can also help identify trends and make informed decisions about inventory levels. Technology plays a significant role in preventing and managing dead stock. Inventory management systems allow businesses to track inventory in real time, while data analytics can help identify trends and inform demand forecasting. Automated ordering systems can streamline inventory management processes, and barcode scanning technology can improve accuracy. Finally, let's discuss the potential risks of not managing dead stock effectively. Reduced cash flow, increased storage costs, decreased profit margins, and damage to brand reputation are just a few of the consequences. Dead stock can also lead to obsolescence, opportunity costs, and inaccurate financial reporting. Common mistakes companies make when managing dead stock include failing to track inventory levels, inaccurate demand forecasting, and not having a clear liquidation plan. It's also essential to understand the difference between dead stock and non-moving stock. While dead stock has a very low probability of being sold, non-moving stock may still have potential for future sales but requires careful monitoring. Understanding the difference between obsolete and dead stock is equally important. Obsolete stock refers to products that are no longer in demand due to technological advancements or shifts in consumer preferences. Dead stock, on the other hand, may still have some market viability, but hasn't sold for various reasons. In conclusion, managing dead stock is crucial for maintaining profitability and competitiveness in any business. By implementing effective inventory management strategies, leveraging technology, and understanding the nuances of different types of stock, companies can minimize the risks associated with dead stock and position themselves for long-term success. So, whether you're a small business owner or part of a larger organization, take the time to understand dead stock and how to avoid it. Your bottom line will thank you